Warren Buffett is one of the most successful investors in history and in this video, we'll be exploring some of his key principles for building wealth. So if you're ready to take control of your financial future and learn from one of the best, let's get started. Start saving and investing early. Starting to save and invest early can be one of the most powerful steps you can take towards building wealth. It may seem intimidating at first, especially if you're just starting out in your career and don't have a lot of disposable income. But even small amounts can add up over time thanks to the power of compound interest. Imagine you're 22 years old and decide to start saving $100 per month in a retirement account. If you continue doing this until you're 67 and your investments earn an average of $7 per year, you'll have over $1 million saved by the time you retire. On the other hand, if you wait until you're 32 to start saving the same amount, you'll only have about $600,000 saved by the time you retire. That's a difference of over $400,000 just because you started saving 10 years later. So don't wait to start saving and investing. Even if you can only afford to save a small amount at first, it's better to start now than to delay. As your income increases over time, you can gradually increase your savings and take advantage of the power of compound interest. In addition to the financial benefits, starting to save and invest early can also help you develop good financial habits and discipline. It can be easy to get into the habit of spending all of your disposable income, but by making saving and investing a priority from the start, you can set yourself up for financial success in the long run. Develop a long-term investment strategy. Developing a long-term investment strategy is crucial for maximizing your wealth-building potential. It's easy to get caught up in the excitement of short-term market fluctuations, but it's important to stay focused on your long-term goals and not make impulsive or emotional decisions. Having a clear investment plan can help you stay disciplined and avoid the temptation to chase after the latest hot stock or trend. It can also help you allocate your assets in a way that aligns with your risk tolerance and financial goals. So how do you go about developing a long-term investment strategy? Here are a few steps to consider. Define your financial goals. What are you saving for? Retirement, a down payment on a house, a child's education. The specific goals you have will determine how you allocate your investments. Assess your risk tolerance. How comfortable are you with the idea of your investments fluctuating in value? Your risk tolerance will play a big role in determining the types of investments you choose. Diversify your portfolio. Don't put all your eggs in one basket. A diversified portfolio can help spread out your risk and maximize your potential returns. Review your portfolio regularly. It's important to periodically review your portfolio to ensure it's still aligned with your goals and risk tolerance. This is also a good time to rebalance your portfolio if necessary. Diversify your portfolio. Diversification is a key principle of investing that can help minimize risk and maximize potential returns. It's all about spreading out your investments across different asset classes, sectors, and geographic regions. That way, if one particular investment underperforms, it's less likely to significantly impact your overall portfolio. But diversification isn't just about protecting against losses. It can also help you take advantage of growth opportunities in different areas. For example, if you only invest in a single sector and that sector experiences a downturn, your portfolio will suffer. But if you diversify across several sectors, you may still be able to generate returns from other areas of your portfolio. So how do you go about diversifying your portfolio? Here are a few strategies to consider. Invest in a mix of asset classes. This can include stocks, bonds, real estate, commodities, and more. Each asset class has its own set of risks and returns, so spreading your investments across multiple classes can help balance out your portfolio. Diversify within asset classes. For example, if you're investing in stocks, don't just focus on a single sector or industry. Consider a mix of large, mid, and small cap stocks, as well as international stocks. Use different investment vehicles. There are many different ways to invest, such as mutual funds, exchange-traded funds, ETFs, individual stocks, and more. By using a variety of investment vehicles, you can further diversify your portfolio. Be disciplined in your spending and saving habits. One of the keys to building wealth is being disciplined in your spending and saving habits. It's easy to get into the habit of spending all of your disposable income, but if you want to achieve your financial goals, it's important to live within your means and save a portion of your income. Here are a few tips for developing good financial habits. Save a portion of your income. Set aside a specific amount of your income each month for savings, even if it's just a small amount at first. As your income increases, you can gradually increase your savings. Avoid unnecessary expenses. Take a close look at your spending habits and see if there are any areas where you can cut back. Do you really need that expensive coffee every day? Could you save money by cooking at home instead of eating out? Use cash or a debit card instead of credit cards. Credit cards can be convenient, but it's easy to overspend when you're not using actual cash. By using cash or a debit card, you'll be more mindful of your spending and less likely to rack up unnecessary debt. Find ways to increase your income. Look for ways to boost your income, whether it's through negotiating a raise at work, starting a side hustle, or investing in assets that generate passive income. Educate yourself about investing and finance. One of the keys to building wealth through investing is staying informed and continuing to learn about finance and investing. The more you know, the better equipped you'll be to make informed decisions about your investments and achieve your financial goals. But where do you start? Here are a few suggestions for educating yourself about investing and financing. Read books and articles. There are countless books and articles on investing and finance. Start by reading a few to get a general understanding of different investment strategies and concepts. Take a course or class. Many colleges and universities offer courses on investing and finance. You can also find online courses and resources on resources, such as MOOCs, massive open online courses, or webinars. Follow financial news and analysis. Stay up to date on what's happening in the world of finance by reading financial news outlets and following financial analysts on social media. Talk to a financial advisor. A financial advisor can provide valuable guidance and advice on building a portfolio that aligns with your financial goals. Don't be afraid to ask questions. If you're not sure about something, don't be afraid to ask for clarification. There's no such thing as a stupid question when it comes to investing in finance. Consider the tax implications of your investments. Before we get to that, I would like to introduce the sponsor of this video, the Frugal Living Handbook. Our comprehensive ebook covers everything you need to know about living a frugal and rewarding life, including creating a budget, identifying areas for cost cutting, and much more. Order our ebook via the first link in the video description and start your journey towards financial stability and security. Now let's get back into the video. When it comes to investing, it's important to not only consider the potential returns of your investments, but also the tax implications. Different types of investments are taxed differently, and understanding these differences can help you minimize your tax burden and maximize your net returns. Here are a few key things to keep in mind when it comes to the tax implications of your investments. Understand the different types of investment income. Different types of investment income, such as dividends, interest, and capital gains, are taxed at different rates. It's important to understand these differences so you can make informed decisions about your investments. Take advantage of tax-advantaged accounts. There are certain types of investment accounts, such as 401k and IRAs, that offer tax benefits. By investing in these accounts, you can lower your tax bill and potentially increase your net returns. Consider tax loss harvesting. If you have investments that have decreased in value, you can sell them to offset capital gains in other investments. This is known as tax loss harvesting and can help reduce your tax burden. Consult with a tax professional. If you're not sure about the tax implications of your investments, it may be worth consulting with a tax professional. They can provide guidance and help you make informed decisions. Don't try to time the market. Trying to time the market, that is, attempting to predict when to buy and sell investments based on short-term market movements, can be a dangerous game. While it's tempting to try to capitalize on market highs and avoid market lows, it's almost impossible to accurately predict these movements in advance. In fact, research has shown that attempting to time the market can actually lead to lower returns compared to simply staying invested over the long term. So what's the alternative? It's simple. Have a long-term perspective and stay invested? Here are a few reasons why it's generally a better strategy to stay invested over the long term. The stock market has a history of long-term growth. While there will always be ups and downs in the short term, the stock market has consistently trended upwards over the long term. By staying invested, you can take advantage of this growth. You can't predict market movements. As mentioned above, attempting to predict market movements is a risky proposition. It's better to focus on your long-term goals and not get swayed by short-term fluctuations. Diversification can help manage risk. By diversifying your portfolio across different asset classes, sectors, and regions, you can help mitigate the impact of market downturns. So next time you're tempted to try to time the market, remember that staying invested over the long term can be a more effective strategy for building wealth. It may not be as exciting as trying to capitalize on short-term movements, but it can lead to more consistent and reliable returns over time. Don't put all your eggs in one basket. We'll get to that in a second. I have a favor to ask of you. If you like this video so far, please subscribe to the channel. When it comes to investing, it's important to diversify your portfolio. That is, don't put all your eggs in one basket. By spreading your investments across different asset classes, sectors, and geographic regions, you can help mitigate risk and maximize potential returns. So why is diversification so important? Here are a few reasons. It helps manage risk. By diversifying your portfolio, you can help reduce the impact of any one investment underperforming. For example, if you only invest in a single sector and that sector experiences a downturn, your portfolio will suffer. But if you diversify across several sectors, you may still be able to generate returns from other areas of your portfolio. It can lead to better returns. Diversification doesn't just help protect against losses, it can also help take advantage of growth opportunities in different areas. By investing in a mix of asset classes and sectors, you can increase your chances of generating returns from multiple sources. It can reduce volatility. A diversified portfolio is generally less volatile than a concentrated portfolio. This can be especially important if you have a shorter time horizon or a lower risk tolerance. Don't be afraid to mix things up. A diverse portfolio can lead to a more secure financial future, so don't put all your eggs in one basket. Diversify and spread out your risk for a better chance at long-term success. Don't be afraid to ask for help. When it comes to building wealth and managing your finances, it's okay to admit that you don't have all the answers. In fact, seeking the advice of trusted financial professionals can be a valuable resource for achieving your financial goals. Here are a few reasons why it's okay to ask for help. Financial professionals have expertise and experience. Financial advisors and other professionals have spent years learning about investing, finance, and wealth management. By seeking their advice, you can benefit from their expertise and experience. They can provide objective guidance. It's easy to get caught up in your own biases and emotions when it comes to your finances. A financial professional can provide objective guidance and help you make informed decisions. They can help you stay on track. A financial advisor can help you create a financial plan and stay on track towards your goals. They can provide accountability and help you stay disciplined in your spending and saving habits. It's okay to admit that you don't have all the answers. By seeking help, you can put yourself in a better position to build wealth and secure your financial future. Keep your costs low. When it comes to investing, one of the keys to maximizing returns is to keep your costs low. This includes everything from investment fees to taxes to trading costs. By minimizing these costs, you can increase your net returns and build wealth more efficiently. Here are a few ways to keep your costs low. Use low-cost investment options. Look for investments with low fees, such as index funds or exchange-traded funds, TFES. These options can provide broad market exposure at a lower cost than actively managed funds. Consider tax-efficient investments. Some investments, such as municipal bonds or index funds, may be more tax-efficient than others. By considering the tax implications of your investments, you can potentially lower your tax bill and increase your net returns. Trade infrequently. Trading frequently can incur high costs, including trading fees and taxes on short-term capital gains. By being patient and holding onto investments for the long term, you can potentially lower your costs. Use a financial advisor wisely. While financial advisors can provide valuable guidance, they can also be a significant cost. Make sure to shop around and find an advisor that aligns with your financial goals and risk tolerance By keeping your costs low, you can increase your net returns and build wealth more efficiently. It may require some research and effort on your part, but it's worth it in the long run. We hope you've learned some valuable strategies for building wealth and achieving your financial goals. Remember, building wealth isn't a get-rich-quick scheme. It takes time, effort, and discipline. But by following the principles outlined in this video, you can put yourself in a strong position to achieve financial success. The journey doesn't end here. Check the first link in the description for our Frugal Living ebook. It's never too late to start making smart financial decisions.